Regarding the MTN issue, we're really excited about the outcome. We went out about a month ago with a bid for 11 billion shillings, which is the largest single non-infrastructure issue in this market. And of course, it was, we'd done our homework, we'd gone out, we'd had conversations with fund managers, we'd done our work around alternative sources of fundings. And so by the time we were going there, we were very clear on what we wanted to achieve and the possibility of achieving it. We're positively surprised. We expected a good subscription level, but the outcome has been overwhelming. And I must say it's quite humbling to see the level of confidence that the investors in the sector have in our company. And it really spurs us to do the right things and to continue to deliver value to them. Two things. One, when we did the previous issues about 5 and 6 years back, first we did a 2-tranche issue, went in for 5 billion, and then we went in for 6 billion in a 2-tranche nature. At the time, business was good, so definitely it was a good outturn as well. In this environment, we went out in COVID times where the economy is struggling, and it was we had to do a lot of work to make sure that this was viable. And again, very encouraging to see that investors are very savvy around good pickings. And so the market is hungry for corporates to go out and raise such funding. So based on our research, went in for the full 11 billion, looked at the rates and the outlook on the rates, and pitched the rate where we thought was a good balance for the investor and for ourselves. And so the outcome, I think, has demonstrated that we did the right things. We were confident going out. We typically, as with the market, set a success rate of 50%. We were confident going out that we would meet our ask, given the amount of work we'd done and all the conversations we'd had before the issue. So we were fairly confident. I would say we were surprised by the 245% oversubscription. But as I say again, I think it's just testament to the kind of company that we are, our track record. We've been in the market before, we've paid out, and our demonstrated results supports the outturn. We did see quite a diverse portfolio of investors, from individuals to banks to cooperatives, quite a pension funds, insurance companies. So the diversity was impressive. And the reason why that's important is that it's important to have a liquid secondary market for corporate bonds, because when they are, then investors don't price in a liquidity premium that makes the rate higher, because they know that if they needed the money, they can go out and sell it and get their money back, as opposed to they then price it for a 5-year period. So having a wide and diverse pool of investors means that you're likely to see a lot more activity. We hope that we'll see a lot more activity on the secondary market, and that over time, and with more players coming in, that we'll see the rates start to come off. So when we look at funding, we think about two things. We think about the tenor and we think about the cost. So if you look at our portfolio, as of January last year, we were holding 11 billion in corporate paper. We paid the first tranche around February last year of about 5 billion, just around the time COVID broke out. And then we paid the second tranche this year, just before the financial year end. So when you look at the tenor of our book, you see that we've got a number of loans which are amortizing. And so the tenor of the book is quite short. And again, if you look at how we've been investing, and we've invested ahead even during COVID, we've spent about 16 billion in CapEx. So a lot of improvements in CapEx, capacity enhancements, and we also bought 30% of Serengeti. So we've gotten into long-term uses of funds. And so it was important for us to match the funding with the nature of the investments. So what this does for us is that it lengthens the tenor of our funding book, but also it gives us a better rate. The previous issues were 12.74 for the first bond that we paid out, and the second one was at 14.95. So the differential also gives us an upside in terms of cost of funding. So those are some of the considerations we took into account when going in. We went in for exactly what we wanted, and we are only going to take what we need. I think if you look at the nature of our business, it is a highly cash generative business. And just last year, even within COVID, net cash generated from operations was 26 billion. So just taking in money for the sake of it comes at a cost. So we would only be going with what we needed, which was the 11 billion. We funded quite some significant projects in terms of capital expenditure and acquisition in the Serengeti Brewery, which were of a long-term nature. And we also paid down the 2 bonds that we had. So coming down from 11 billion corporate paper, all of that being refinanced by bank funding that was more short-term in nature, meant that the tenor of our book was shortened. So the real aim of this is really to make sure that we match the funding with the use of funds so that you have longer-term funding for longer-term users, and also that we get a good mix of funding between corporate paper and bank funding. So in essence, we are using it for refinancing some of the short-term debt in order to lengthen the book. We're also using it for working capital. At a time of COVID, you need to make sure you're always covered. And also, we continue to grow and expand. And so whilst we generate a lot of cash, we are very bullish in the current environment, and we continue to grow and expand and invest in our markets.